Something happened at 3 a.m. in Shanghai last night. And I am not talking about some small price fluctuation or a routine overnight trade. I'm talking about an event so unusual, so quietly executed, that by the time most investors in the West wake up on Monday morning and check the silver charts, many of them are going to be staring at their screens, wondering what exactly just unfolded. So stay with me for the next few minutes, because what I'm about to walk you through could fundamentally change the way you think about the silver market. This is not hype. This is not clickbait. I have been watching these markets closely for years. And when the alert came through at 3:00 a.m., I got out of bed immediately, sat down at my desk, and started going through the data. Because what happened was not normal, and more importantly, it is something you need to understand before the Western markets open. I'm John OG, and welcome back. If you are new here, this channel is where we break down what is actually happening in metals and macro markets. No Wall Street talking points, no sugarcoating, just the real mechanics behind the moves. Now, before we dive deeper into what happened in Shanghai, I want to ask you something directly. Are you watching silver right now? Because if you are holding physical silver, if you have exposure through ETFs, or if you have been considering entering the market, what happened at 3 a.m. could influence your next decision more than any headline you're going to see on Monday. So let's unpack this. First, we need to establish the backdrop, because context is everything. Silver has been on an extraordinary run over the past several weeks. We watched it push past $80, then surge toward $85. And there were moments where it genuinely looked like $100 an ounce was no longer some distant fantasy, but a realistic target. But every time silver approaches that breakout level, something happens. Margins get raised. Large paper sell orders suddenly appear. Institutional traders step in and push the price back down. We have seen this pattern repeatedly. And many people have pointed fingers at the usual players, major banks, institutional short sellers, and the structure of the futures market itself. But what happened in Shanghai is different. This time, the signal didn't come from New York or London. It came from the other side of the world, and that changes the equation. You see, the Shanghai Futures Exchange is not just another trading venue. It is one of the clearest windows into what China, the world's largest producer and consumer of silver, is actually doing with the metal. Not what officials say publicly, not what analysts speculate about, what they are actually doing in real time with real contracts and physical metal. And for the past several weeks, something strange has been happening there. Inventory data started behaving oddly. Reports that should update consistently began appearing late. Numbers became inconsistent. Some days there were gaps in the reporting. And then something even more unusual happened. The inventory reporting effectively went dark. For an exchange of that scale, that is extremely unusual. When an exchange stops showing clear inventory data, it usually means one of two things. Either something embarrassing is being hidden, or something very large is being prepared. Based on what we saw at 3:01 a.m., it appears to have been the second. Because at approximately 3:01 a.m. Eastern Time, during active trading hours in Shanghai, silver futures on the exchange moved in a way that did not align with Western spot prices. The price behavior diverged. Now, for most casual investors, that may not sound like a big deal. But in global commodity markets, when Eastern and Western prices start diverging significantly, it usually signals something very specific. Physical metal is moving, not just contracts, not just speculative trading, actual silver changing hands at a price that is different from what the global paper market is quoting. And that is where this gets interesting. Imagine you are a large Chinese institution, a sovereign fund, a state-linked manufacturer, or a government-aligned entity responsible for securing industrial metals. And imagine you want to acquire a very large amount of physical silver. If you attempt to buy it aggressively in Western markets, you immediately drive the global price higher. Everyone notices. But if you accumulate in Shanghai during Asian trading hours, while Western traders are asleep, you can quietly build positions before the broader market reacts. By the time New York opens, the metal is already purchased, allocated, and moved into long-term storage. And we have seen versions of this pattern before. Back in 2010 and 2011, when silver ran from around $18 to nearly $50 an ounce, much of the demand surge came from Asia, Chinese investors, Indian buyers, institutional accumulation. The Western paper market tried to slow the move with margin hikes and liquidity restrictions. Sound familiar? Because we just saw a major margin hike recently, followed by a quick adjustment shortly afterward. These events rarely occur in isolation. They are usually part of the same broader story. And if you are still watching right now, that tells me something important about you. It means you are not just chasing headlines. You are trying to understand how these markets actually function. And that matters. Because the next piece of this puzzle is something most analysts never explain clearly. The global silver market is connected through arbitrage. When silver is cheaper in one market and more expensive in another, traders jump in to exploit the difference. They buy where it is cheap and sell where it is expensive, closing the gap. This mechanism keeps global prices aligned most of the time. But when physical demand becomes intense enough, the arbitrage mechanism can break down. The gap widens instead of closing. And when that happens, traders call it a dislocation, a point where the paper price you see on your screen no longer reflects what it actually costs to obtain physical metal. We have already seen hints of that. There have been moments recently when silver was trading in the mid-80s on paper while physical dealers were charging dramatically higher premiums. That gap is not random, it is a signal. And the move we saw in Shanghai may be the next step in that story. Now the real question becomes this: what does it mean for Monday morning? There are three possible scenarios. The first is what I call the quiet open. In this case, the accumulation in Shanghai happens quietly and the Western market barely reacts. Silver opens slightly higher, maybe a percent or two, and most investors never realize anything unusual occurred. But beneath the surface, the available supply is already tightened. The second scenario is the volatile open. Information from the Asian move begins circulating over the weekend through trading desks, forums, and industry channels. By the time New York opens, the market already knows something happened. Silver jumps several percent quickly and short sellers rush to cover. Moves like that can accelerate rapidly. The third scenario is the one that would truly make headlines. I'm not predicting it, but it has to be acknowledged. If the scale of the accumulation was large enough, Monday could open with a significant gap higher, the kind of move that forces exchanges and major traders to respond quickly. And if that happens, it would confirm something many people in the metal space have been warning about for years: